What if I told you that one of the most closely watched investors in the entire country just made 6 very specific stock purchases? And that same investor has outperformed the S&P 500 by more than 3 times over the last decade. We're talking about Nancy Pelosi. And before anyone in the comments comes for me, I don't care about your politics. Neither should you when it comes to your money. What I care about is returns. And an 830% gain on your portfolio over 10 years? That's not luck. That's pattern recognition. So today we're breaking down every single stock the Pelosi portfolio has picked up in 2026, all 6 of them. I'm going to give you the bull case, the honest risks, and I'm going to rank them from best to worst by the end of this video. No fluff, no sugarcoating. If you're new here and you want real stock analysis every week, not hype, not noise, just the actual numbers, hit that subscribe button right now and turn on the bell. We drop new content every single week, and you do not want to miss what's coming. All right, let's get into it. Now, the purchases I'm about to show you were all reported to the SEC from the most recently filed quarter. Politicians only have to disclose ranges, so we're working from estimates tracked on QuiverQuant, but the direction of the bets? Crystal clear. And when a portfolio that's tripled the market starts stacking up AI-heavy positions at the same time AI stocks are on sale, that's worth paying attention to. Let's sort these from smallest to largest purchase and work our way up. First up, Tempest AI. Ticker symbol TEM. Estimated purchase around $75,000. Now I know what some of you are thinking. That's the smallest buy on the list. Why even bother? Here's why. When a smart investor starts a small position in something early, they're often planting a seed. They're not all in. They're watching. And with TEM, there's a lot worth watching. Tempest is the crossroads of 2 of the biggest investment themes right now: artificial intelligence and healthcare. That combination alone gets your attention. But what makes Tempest genuinely interesting is what they've actually built. They're sitting on over 450 petabytes of clinical and molecular data. To put that in perspective, most companies in the world couldn't even dream of collecting data at that scale. And that data is the moat. You can't replicate it overnight. Right now, they're already embedded in more than half of all academic medical centers across the country. More than 5,000 providers are actively using their platform. That's not a startup fantasy. That's real institutional adoption. Here's a number that really stood out to me when I was looking at this. Last year, revenue grew by 80%, and they cut their GAAP losses by 65% in the same period. They're even guiding for positive adjusted EBITDA this year. This is a company moving in the right direction fast. But, and there's always a but, the stock has been absolutely crushed, down close to 50% from its highs. The macro environment has been brutal for speculative growth names, and Tempest has felt every bit of that pain. So is the sell-off overdone? I think there's a strong case that it is. For a long-term investor, especially one buying small like Pelosi appears to be here, this looks like a calculated dip buy on the future of AI-driven medicine. For me personally, I'm already heavy in biotech, so I'll pass for now. But if you've got room in your portfolio for a high-upside healthcare AI play with real institutional traction, Tempest is worth a serious look. I'll slot this one in at number 4 on my rankings for now. Let's see if anything knocks it higher. Before we go any further, are you already holding any of these names? Drop it in the comments below. I'm genuinely curious what you guys are already in. And if you're getting value from this breakdown so far, smash that like button. It really does help this channel more than you know. All right, purchase number 2, Vistra Corp, ticker VST, estimated around $200,000. And this one is fascinating. On the surface, Vistra is a utility company. Energy. Old school, boring, right? That's what most people see. Here's what most people are missing. Vistra is becoming one of the most compelling indirect AI plays in the entire market. Why? Because AI runs on power. Massive, uninterrupted, 24/7 power. And the data centers fueling this AI revolution. They need more of it every single year. Vistra is one of the companies delivering exactly that. What really sets them apart, though, is nuclear. Vistra already has operating nuclear capacity. That is not easy to come by. It takes decades and billions of dollars to build. But these data centers don't just want any power. They want clean, reliable, baseload power. Nuclear checks every single box. Now look at the financials. Their numbers have been breaking records recently. Revenue and cash flow have surged as demand for their power has risen. But energy stocks are volatile by nature, and Vistra has pulled back about 25% from its peak. That pullback has created something interesting. Their valuation is now roughly in line with the sector on a PE basis, and get this, about 70% cheaper on a PEG basis. That means you're paying a discount for their growth rate relative to peers. That almost never happens with a company in this position. One more thing worth noting. Pelosi is a Democrat. Low-emission energy is a core policy priority on the left. So buying a nuclear power company with major data center exposure? It fits politically and financially. I think this is a genuinely smart buy. I'm moving it up to number 2 on the rankings for now. Okay, here we go. NVIDIA, ticker NVDA, estimated purchase around $375,000. The king of AI. Now I can already hear the skeptics. NVIDIA is already huge. The run is over. It's too expensive. Let me tell you why I think that's wrong. First, the market share. NVIDIA controls an estimated 90% of the AI chip market. 90%. That's not dominance. That's a monopoly with branding. There is no real number 2 right now in the AI accelerator space that's within striking distance. Second, the financials. Last year, NVIDIA generated $215 billion in revenue. More than half of that dropped straight to net income as profit. Both figures were up over 60% year over year. That's 60% growth on a company generating over $200 billion in sales. Find me another company doing that? I'll wait. Now here's the valuation point that most bears conveniently skip. Their PEG ratio, which adjusts the price-to-earnings multiple for growth, sits below 1.0. That's about 55% below the sector median. In other words, the market is not fully pricing in their growth rate. You're actually getting a discount on the most dominant AI company in the world. The stock has been flat for several months now, trading sideways since last November. The market is debating whether the price is justified. My answer is yes. When you run the numbers honestly, it's justified. The risk here is straightforward. Competition will intensify over time. AMD is pushing hard. Custom silicon from Google and Amazon is advancing. NVIDIA's moat is strong but not permanent. That's the honest caveat. Still, for sheer dominance in the most important technology trend of our generation, NVIDIA earns the number 1 spot on this list. For now. Okay, we're about halfway through. If you're watching this far, you're clearly serious about this stuff. So do me a favor and share this video with someone who's trying to build real wealth. They'll thank you for it. Now things get really interesting, because this next purchase might just knock NVIDIA off the top spot. Amazon, ticker AMZN, estimated purchase around $750,000, the second largest buy on this list. Most people still think of Amazon as an e-commerce company. They are so much more than that. Amazon Web Services holds 28% of the global cloud market. Number 1, no one else is close. And as AI adoption accelerates, demand for cloud infrastructure goes up. AWS is one of the direct beneficiaries of every AI dollar being spent. But here's what's quietly becoming one of Amazon's most powerful businesses: digital advertising. Because Amazon owns the shopping experience, they know what people are actually buying, not just what they're searching. That makes their ad platform extraordinarily valuable to brands. Last quarter alone, their ad revenue came in over $21 billion. And it's growing faster than AWS. Think about that. They've essentially built one of the world's most profitable advertising businesses inside a shipping and cloud company. The margins on that business are likely even higher than AWS when you strip out infrastructure costs. Now look at the valuation. Amazon as a whole is trading well below $3 trillion in market cap today. NVIDIA, a company with a fraction of the revenue, is sitting near that same level. I like NVIDIA. I own NVIDIA. But rationally, the size and diversification of Amazon versus its market cap doesn't fully add up. Their revenue last year was close to $750 billion, and it still grew by double digits. No other company at that scale is doing that. Risk? They're spread across more businesses, which means more execution risk. And AWS growth has periods of deceleration. Those are real concerns. But overall, Amazon's combination of scale, diversification, and long-term compounding power puts it at number 1 on my list. NVIDIA drops to 2. All right, last one before the big finale. And I want to be honest with you. This one almost tied Amazon for the top spot. Alphabet, ticker Google, also around $750,000 estimated. Here's the case for Google in one sentence. No company on the planet owns the user relationship across more platforms simultaneously. Search, Android, Chrome, YouTube, Gmail, Maps. That's your entire digital life. And they're weaving AI through all of it. The winner is going to be whoever has the deepest integration with the user's existing life. Google has that. Microsoft is chasing it. The others are fighting for attention. Now, YouTube alone, which Google bought for less than $2 billion back in the day, is now arguably worth over $1 trillion on its own. The rest of the business is just gravy. Financially, Alphabet generated over $130 billion in net income last year. That was up 32% year over year. The cash machine is running at full speed. Here's my honest differentiator, though. Of the 3 mega-cap tech stocks on this list, Google carries the highest PEG ratio. Not bad, just the highest of the 3. That's the one thing pushing them to number 3 behind Amazon and Nvidia on my rankings. But to be clear, if you don't own Google, you should be asking yourself why not. And finally, the elephant in the room, AllianceBernstein, ticker AB, the largest purchase by a mile at an estimated $3 million. No AI angle here, no cloud story, no growth thesis. This is a wealth preservation play. AllianceBernstein is a major asset manager structured as a master limited partnership, or MLP. The key feature of an MLP? They pass almost all their cash flow directly to shareholders as distributions. No corporate income tax in between. The result is a dividend yield sitting close to 10% right now. For someone like Pelosi, older, already wealthy, looking for reliable income, that makes a lot of sense. They're managing close to $800 billion in assets. They're expanding in Asia Pacific, and the stock's underperformance in recent years is exactly what's driven that yield so high. For me, too boring. I can find better returns elsewhere, and I'm willing to be patient to get them. But I'm not the target buyer here. If you're in or approaching retirement, building passive income, or just want a high-yield anchor in your portfolio, AB is worth a serious look. But on this list, for growth purposes, it lands at number 6. All right. Let me bring it all together with the final rankings. Number 1, Amazon. Unmatched size, diversification, and long-term compounding across cloud, ads, and AI. Number 2, Nvidia. The undisputed king of AI infrastructure. Dominant market share. Discounted PEG, hard to argue against. Number 3, Alphabet. The most integrated AI ecosystem in existence. $130 billion in net income. YouTube alone is $1 trillion asset. Number 4, Tempest AI. High risk, high reward. Real traction in AI-powered healthcare. Best for a small speculative position. Number 5, Vistra Corp. The sleeper of the group. Nuclear energy plus AI data center demand plus a cheap valuation. Underappreciated play. Number 6, AllianceBernstein. Great if you want income and preservation. Not my style, but totally valid for the right investor. Now, do I think you should blindly copy Pelosi's trades? No. Every one of you has a different time horizon, risk tolerance, and tax situation. This is research, not a recommendation. Do your own homework. Always. But is there something worth learning from a portfolio that's returned 830% over a decade? Absolutely. And right now, that portfolio is clearly betting big on AI infrastructure, energy, and diversified tech. That's the lesson. Okay. 3 things before you go. First, smash that like button if this breakdown gave you something useful. It takes 2 seconds and it genuinely keeps this channel alive. Second, subscribe and hit the bell if you haven't already. New stock analysis drops every week and you do not want to miss the next one. Third, drop a comment below. Which of these 6 stocks are you most interested in? Are you already holding any of them? I read every single comment and I'll reply to as many as I can. Thanks for watching, my friends. Take care of yourselves, and I'll catch you in the next one.